Hi, I'm Laura Suter from AJ Bell, and I'm joined by Ryan Hughes, Head of Active Portfolios at AJ Bell. Thanks for joining us.
Hi there.
So what's the market reaction been to coronavirus so far?
We've seen quite a mixed reaction when we look at both the equity market and the bond market. So equity markets have been hugely volatile, with some big falls coming particularly last week in developed markets. That was hot on the heels of some big falls in Asia that we saw a couple of weeks before. When the crisis really escalated, the Chinese market was closed, and when it reopened, it fell around 10%. The Chinese government then announced some stimulus, and the market rallied very strongly at that point. But over the last week, as the crisis has really escalated in Western Europe and indeed the US, then those developed markets, equity markets, have started falling sharply as the worries over what this does to the global economy start to rise. Now, bond markets have been behaving a little bit differently at that point, where because of the risk off nature, so people are worried, then government bonds, which are typically seen as a safer place to invest in times of crisis, they've actually been performing very well. So we've seen US treasuries, we've seen UK gilts perform quite strongly over the last week. But equity markets, bond markets remain very volatile. Absolutely. Last week with big falls. Right now, as we record this, equity markets are actually up quite sharply. So it's quite difficult to see a pattern, and we expect this volatility to continue for some time.
And how have the AJ Bell funds held up during that period?
Well, I mean, naturally, the AJ Bell funds are exposed to the markets, they're exposed to equity markets, they're exposed to bond markets. So it's very hard to be immune from the falls that we're seeing in equity markets right now, and therefore the funds have naturally fallen back in prices as this volatility has hit markets. However, what I would say is it's important to think about how we design these funds and put them together. So we build diversification into the portfolio. So that means having a mix of different asset classes, of equities, of bonds, right around the world, different types of assets that behave differently in different times. When we look at the more cautious end of the portfolio, then they have higher weightings to bonds and government bonds, and they perform generally quite well during market volatility, equity market volatility. As we move up the risk scale towards the higher risk end, then they have more and more equities in the portfolio, and that's where we've seen the really big volatility and some of the big sell-offs in markets. And so different portfolios are impacted in different ways when we see these type of events. But I think what's important is also to think about how we invest. So we invest for the long term, but also what we do when we design these products is we continually stress test them to see how they behave in this type of environment. What we're seeing is actually the performance of the funds is well in line with our expectations of a stress scenario. Now, what you can see on the graphic on the screen is that the range of outcomes for the fund over a period of time. So for each fund that we have, you'll see a bar, and that represents a most likely typical outcome over a long period of time, both in terms of how the fund should perform when things are going well, but also how funds are likely to perform when things are going badly. Now, what we can see is the outcome we're seeing now over the last week is well within those bars of expectations.
Have there been any significant changes to the funds or anything that investors should be aware of? Our
investment philosophy is to invest on a long-term basis. Now, that really for us means investing on a 5-year plus view. And the way that we approach that is we update our asset allocation on an annual basis. Now, we very recently implemented that in mid-February. We made some small changes to the portfolios based on our long-term view of what we think's likely to happen around the world and the performance of different asset classes. Within those changes, we added to the mix of our fixed interest exposure, so our bond exposure. That included adding some US treasuries, so some government bonds issued in the US. It also included changing the mix slightly of our equity portfolio in the way that we mix the assets when we invest around the world. But what we don't want to do is to react to market events. When you have huge periods of volatility, it's very dangerous to try and chase returns. You've seen huge falls on one day and then huge rallies the next day. And if you're trying to chase that and time that, you run the risk of actually getting both elements of that wrong, which can be hugely damaging to long-term returns. So we want to stick to our investment philosophy which is to be outcome oriented, to be long term, to be cost conscious and valuation driven.
In times like these, it can be easy for investors to panic. So what should they be thinking of at the moment?
I think really important in volatile times is to stay calm, think rationally. Now, naturally, as you can imagine, as our investment team has been meeting to discuss what's going on with coronavirus and how we think it's likely to impact the global economy, to determine whether we think it's worth making changes to the portfolio. But more broadly for investors, it's about making sure that you stick to your financial plan, to your objectives, and actually you understand your own attitude to risk, because it's quite a dangerous strategy trying to time markets when we're seeing such huge volatility. And in fact, some data shows that over the last 20 years, if you'd missed out on the 10 or 20 best days stock market performance in that period, rather than simply staying invested through the whole time, would have had hugely damaging consequences for the overall performance of your portfolio. So a couple of adages really, and well-known sayings, as Warren Buffett says, be greedy when others are fearful and fearful when others are greedy. But also thinking about the long term, it's about time in the market, not timing the market, that becomes very important.
And so what's the outlook for markets for the next few months and going further into the year?
Firstly, we have to acknowledge the genuine human tragedy that this is. Thousands of people have lost their lives and many, many more continue to be affected by this. That goes much bigger than economies and stock markets and so on. We are not healthcare experts. We don't know how this will continue to play out. We don't know how it's going to spread, how far it's going to spread, and how many people are going to be impacted. What we are seeing is talk of central banks acting if necessary, so the ECB in Europe, the Federal Reserve, and indeed here in the UK, taking appropriate action to help economies. And of course we've got the budget coming up in just a few days' time, and I'm sure that in the budget, if appropriate, that there will be additional measures to help the economy and help people come through this, to hopefully minimise the impact that there is on the economy, but that's very, very difficult to do. Now, naturally, we will be keeping a very close eye on what is happening, digesting the news flow, and trying to determine whether we need to make any changes to the funds as and when more news becomes available. If we do need to make any changes, then absolutely we will ensure that all of our investors are kept well informed about what is happening in the funds.
Thanks a lot for joining us today and talking us through all of that.